Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time. Today's episode, we're talking about a very exciting topic, QSBS. And this is just a way that we've seen small business owners save an enormous amount of taxes when they sell their business. But some simple, some complex rules that we're going to simplify today for you, give you some real life examples of how this can be done. So first of all, James, what does QSBS stand for? Just give us a general breakdown of it.
Yeah, it stands for Qualified Small Business Stocks. It's Section 1202 in the tax code. Long and short of it is if you are a qualifying business, which we'll talk about, and you sell your business, a portion of the sale can be tax-free, which obviously could be pretty huge.
Yep. So this is capped at 10x your basis, right, or $10 million. So just for an example, if you have a business that you have a basis of 10 million, now you're selling it for 20 million and you meet all the requirements, you would be able to avoid the federal capital gains tax on that $10 million gain, which would be, if you're in the highest tax bracket, would be, a $2.38 million tax savings, just as a simplicity.
And just to make sure people understand that your basis, you're not going to pay tax on your basis regardless. If you weren't QSBS, it's just the gain that you would pay taxes on. So, 10 million of the gain essentially you could avoid. Absolutely.
So let's go through just first, like what are the conditions that need to be met? And so the first condition is, we'll just go back and forth here, Jamison. So the first is you have to be a C corporation. And so C corporation does come with some downsides. There's double taxation. When looking at, let's say someone's profiting over $1 million, and they're an S corp structure right now, and if you flip to a C corp, generally speaking, leading up to the sale, you're going to pay an effective tax rate maybe 2 to 5% higher than you're already paying. So you are going to pay a little bit of a higher tax. So let's say you're paying $20,000 to $50,000 a year higher tax for 5 years. Let's just say $250,000. In exchange, if you save that $2.3 million, obviously, that's still a $2 million plus savings of taxes. But you need to be aware of that. You have to be in C Corp. C Corp with the rules of double taxation typically do come with higher tax rates as you're going if you're cash flowing out of the business. Now, if you're retaining earnings, keeping money in the business, it could be a little bit lower, but it's going to get double taxed later and catch up on the back end. So if you don't plan on selling, generally speaking, you should stay as an S corp, maybe an LLC partnership because of the rules. If you specifically are looking as a small business owner to sell, then the C corp, for the purposes of the QSBS, could make a lot of sense. So, James, with that being said, what's rule number 2?
The size of the small business. So, company's gross assets must be $50 million or less at the time of the stock issuance, and then so basically, let's say you have an S corp, you're thinking you're going to sell in 5 years, you flip to a C corp. At the time when the C corp stock is issued, the total assets have to be under 50 million, and then that would qualify you for QSBS.
All right. So number 3, active business requirement: you have to have at least 80% of the company's assets must be in a qualified trade or business. So some industries do not apply. Professional service like law, accounting, unfortunately. Financial services, we can't do this. Healthcare, banking, insurance, financing, and investing businesses, and hotels, restaurants, and similar businesses. So those are the ones that you can't. Examples of ones that could, for example, would be like HVAC company.
Tech this is huge in tech.
Tech is massive. We've had lots of clients in tech startups that have done this, and we've seen some companies have successfully hit and used this to avoid. Mm-hmm. We're talking millions and millions of taxes. Okay, so number 4.
So the way that the original stock is issued, the stock must be purchased directly from the company, not from another shareholder. So let's just example here. Let's say Matt and I are 50-50 partners in a business, and let's say Matt 100% owns the business and I'm going to buy 50%. the way the transaction would have to occur, I can't buy it directly from Matt. Matt would have to sell his 50% back to the business, and then I purchase the shares from the business. So you can't buy them from an individual. It has to be from the corporation.
Yeah, very important to note. And so, typically this is for like founders, maybe the first 10 or 20 team members that, were attracted on, take a high risk in like a tech startup that got offered equity up front. Right from the get-go. So, holding period requirement, the shareholder must have the stock for at least 5 years before selling to qualify for the tax benefit. So that could mean if you're a 100% business owner, you're converting from an S to a C-Corp, doing so 5 years before the sale would guarantee eligibility, assuming you meet these other 4 requirements. And then, or, let's say you're part of a tech company and you go public or you get acquired. You've been, holding the stock for 2 years. You would want to continue to hold that for another 3 years after to meet that total 5-year requirement. So, okay. So now the laws around this have changed. And so there's been some adjustments and dates as far as exclusion amounts. So James, do you want to walk us through those and what that means?
Yeah, so you get 100% exclusion if the stock was acquired after September 27th, 2010. These are interestingly like specific dates. It's kind of funny. 75% exclusion if the stock was acquired between February 18th, 2019 to September 27th, 2010. 50% exclusion if the stock was acquired before February 18th, 2009. So basically, long and short of it, anything after September 27th, 2010, you'll get 100% exclusion on those, either 10x your basis or 10 million.
Or cap at 10 million, whichever one, yeah.
And then I think one thing that's important to know is these are stackable. So what that means is, let's say you own 100% of a business, you're married, you have a spouse, you have 2 kids. You could theoretically take a portion of the stock, have your wife or spouse own it. You could take the other, portion for your kids, have a trust own it for the beneficiary, and the kids would be beneficiary. That's 4 $10 million exemptions that you could use.
So say that 4 again, the business owner, your spouse, trust.
Two
different
kids.
trusts.
Oh,
okay.
Yeah, 2 trusts.
So in that example, let's say you have a $10 million basis in a company and you're selling the company for $50 million. Before the sale, 5 years before we convert from an S Corp to a C Corp, you retain 25% ownership. You make your wife 25% ownership. You make the trust for child 1 25% ownership, and trust for number 2 for child number 2 25% ownership. You sell the company for $50 million. We're now avoiding 23.8% federal tax on all $40 million of gains.
Mm-hmm.
So if you're in that example, $40 million gain, a wife and 2 kids with the 2 trust, we're paying 0 taxes. Plus, you want to have that money in a trust also because then you're going to avoid estate taxes in the future on that. You're going to utilize the majority of your lifetime exemption, but typically after that sale hits, then you can reinvest that money in publicly traded stocks or other vehicles inside of the trust.
Yeah,
So,
and then from a state standpoint, there are a couple of states that exclude this. So all that means is you can still get the federal tax savings, but you may still have to pay state taxes on the sale, which is obviously far less than what the federal taxes are.
Absolutely. So you, just as an example, like Pennsylvania is one, California, Mississippi, Alabama. If you're a business owner in those states, you can absolutely still do QSBS and avoid that big 23.8% federal tax, but you're still going to pay state taxes on the gain. So in Pennsylvania, you still pay the 3.07% on the capital gain. Doesn't mean you can't do QSBS. It just means you have to pay the state taxes still. Perfect. Well, I think that's it for the high level. This is very case by case. It's a very case by case structure. I think this is a no brainer at certain levels. If your goals are legacy for the kids, you're selling your business, and being tax efficient is important, and you're on the back end. And if you're a 25-year-old and you have a 25-year runway, and you're not planning on selling the business, probably a C-Corp operating for 25 years doesn't make sense. There's a break even there. So this is a no-brainer for some clients that want to sell, but for some clients that are unsure or have a huge runway, we would steer clear of it.
Yeah.
But that's a case-by-case analysis that we can do for those interested in reviewing this.
Yeah. And let's give these two like real examples. So one, let's say you have a tech startup. Founder starts a C-Corp company or converts the S-Corp to a C-Corp, issues himself 1 million shares. 5 years later, the company's acquired for $50 million. The founder's shares are now worth $20 million. If the shares qualify for QSBS, the first $10 million are tax-free. Remaining $10 million could be capital gains tax, or like Matt said, if there's a $10 million basis in there, you could avoid the first $10 million, avoid the second $10 million of tax as well. And another example, if you're an investor in a company, let's say you invest $500,000 in a qualifying startup that's going for QSBS. After 5 years, the shares are now worth $5.5 million. In that scenario, the entire $5 million of gain, again, your $500,000, your basis is tax free. So it can work, if you're investing or if you're the business owner.
Absolutely. Okay. Any other closing thoughts? I think this is a...
Yeah, I would just say it's becoming more and more relevant now because there's a huge, 85% of wealth in America is with people over the age of 65, some statistic like that.
Yeah. A lot of people are going to be exiting their businesses and looking to sell.
Yeah, a lot of baby boomer generation business owners that will be going to retire that this could be really applicable for.
Awesome. Well, thanks for joining us, and look forward to catching everyone next week. Feel free to reach out with any questions on QSBS.
Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast, and please share with any friends or family members that would also find this beneficial. Thank you very much.